Rose, while we're waiting for everyone, I felt like our conversation got cut off yesterday. So I just want to make sure you got everything that you wanted from me.
Hi there. Uh,
Hi.
so I joined for Rose, who's a young woman I'm trying to mentor, but
Okay.
she's not able to. She was here for the first part, but she's not able to join the second.
No
So
problem. It's just yesterday I was chatting to her in the chat room privately, and she was asking me for recordings from the previous days, and I was busy sending them, and then the Zoom ended. So I just wanted to make sure that she got everything.
I'll check. I think she did, but
If she hasn't, she's welcome to contact me. I'll put
okay.
my number in the chat box quick.
And
And
also,
anybody is welcome to contact me if they need anything.
can you send the link again for the women's group?
Yes, I'll send it now. I'll put it here.
Can I?
Sorry,
Yeah.
Bart, I'm
We
taking
should put
over.
it in the WhatsApp group as well, Kelly.
Yeah, I'm going to put it in all the WhatsApp groups. Um,
Okay, that's great. Thank
Thomas, I love your background, dude. It's
Yeah, I was actually, I saw the Women in Wealth invite there, so I was going to ask, are we able to share that with our women friends or lady friends?
yes, please do.
yeah, please do.
Okay.
I'm going to mute myself.
Yeah. No, it's all good. Cool. Okay, let's rock and roll. So it's time for day. Kelly's put a number in there if anyone needs to reach out to her or anything. Okay. So it's time for the Q&A for day 3. And again, just reminding you, I'm not going to be giving any financial advice specifically today because we're going to be going into portfolio planning now. But what I wanted to do was we're going to go into this portfolio planning and this asset allocation. Now, this is a conversation that we've had already in this group. And on top of that, I'm going to share with you a tool now. Now, this tool was created, again, by a conversation, and Alan, I know, wanted a bit of a break. I don't know if he'll join us, but the point being is he's one of our mastermind members. And yes, he's got access to the family office, but he's always saying that the financial industry is just not giving you this access and this knowledge. And so we went and did the research, and we said, like, right, what is the 50-year trend analysis? Just by the way, I learned this from Australia. And he said, if you want to look forward 5, 10 years, then you need to go back like 20, 30 years, because like trends are long-term analysis, okay, in terms of that process. And then, funny enough, I learned it more from Ray Dalio, because Ray Dalio said, well, like, actually, you should look back 500 years in history, and you should look at all the patterns and when money repeats itself and what happens with long-term debt and all that. We spoke about all of that on Monday. And so going back a long time is a great thing. So what I did when I did the research is I said, right, I want to take, and again, for you VIPs and wealth hackers and mastermind members, like, I'm going to let you in on some of the secrets of how I do this. So what I do is I take all of the knowledge that Anthony's teaching, and I take that and I chuck it into AI. And I say, like, right, take out all the most important parts here. Okay, so that it understands the deep analysis of what he's doing when it comes to portfolio construction. And then I put in Knight Frank, and I put in Knight Frank's report, and I put in its portfolio construction. And I said, right, go and look at Knight Frank's research over time. And then I said, right, take a 50-year analysis across the different assets and look at all the different trends back to asset allocation. And finally, I said, take into account the macro things that are happening right now: inflation, interest rate, geopolitics, tariffs, all of these things that are happening at the moment. And I said, right, take all of this into account and now recreate what we would do in terms of our different assets. And what should our asset allocation be per asset, and then also per age group? Because what someone in their 20s should do and what someone in their 80s should do are different. And finally, I said, tell us why. What would that look like? So before I go any further, does what I'm saying so far make sense? Yeah? Yeah? And hopefully after today, it makes a lot more sense. Like, if I just shared this with you yesterday even, it wouldn't, hopefully, well, I doubt it would have made as much sense unless you'd kind of heard what Anthony went through with the 6 pillars to wealth and Garth just for the VIP members, just do me a favor. Was it valuable listening to Anthony? And I mean, I hope all of you, some of you might have heard it before. And even if you have heard it before, this was actually an updated one. I don't know if you noticed that. In terms of the process, it had the buckets, and it was a bit of a longer one than the one I used to share. Now I've had the privilege of doing that with him now 4 times, at least 4 times, because I've done it 3 times online, and I've done it twice at the Wealth Weekends. So I've done it 5 times actually, and so it's still, to me, today I sat there and concentrate. Like, I just want to put that in perspective. So today was okay, sorry, I'm not even including the times I've done it during the challenge. So if that's the case, I've done it like 13 times. But my point being is that, like, it's don't underestimate how much depth and knowledge is in what he's sharing. Okay, like I can't overemphasize it for you. You know, I was watching today, and that's why I was asking people, like, what were your tidbits? What are you taking away? Because there's so much profound knowledge that he's sharing in there. And obviously Garth is kind of setting it up, and hopefully it's all sort of coming together for you in terms of that process. So I can see here, Connie, absolutely too right. Yes, absolutely. Okay. So I'm glad you all enjoyed it. So what I want to do now is I want to kind of go through this report. So some of you might have seen this report. I know a couple of you are kind of part of the Wealth Hackers, and you join me on a Friday. But let's go review this, because today's the day to review this, because it's relevant for the for today, which is all about asset allocation. So you can see here, and I'm going to share it with you. You can go read about how to do it. So, and like, what was the data analysis that we took, and how we did it. And then you can see here the framework as well, the risk tolerance, income. Now, just by the way, after today, does anyone know where that came from? 6 pillars to wealth. Hopefully you're joining the dots now. I always joke with people, there's a reason that I cum laude both my degrees. And it's not because I'm super smart. It's because I know how to go and find the information and copy it. Okay, so what I mean by not copy it, as in plagiarize it, but like find out what's working and copy it. So when I did my dissertation in '98, I went into the university and I said to the librarian, I said, who cum laude their dissertation last year? And she's pointed me to the thing. I went and took the best one, the person that got the highest marks. And I went and took it. I took it out of the library, took it home, and then I copied its structure. And I actually cum laude my undergrad, my honors degree. So much so that when I did my MBA, I followed that exact same process. Now, to do a master's, to do a doctorate takes 3 years. I don't know if you know that. My master's dissertation was so strong that they offered it to me to do my PhD in 1 year. And I seriously considered it, because my brother's a doctor, and it would have been nicer to become a doctor before him. Just there's a bit of rivalry within our family. But then I thought to myself, like, I've always wanted to be an entrepreneur. What the hell am I doing? Like, I'm just going to have a bunch of fancy titles next to my name. The only reason I'm telling you that story is it's the same philosophy you'll learn about me over and over again. Who's doing it? Are they doing it successfully? Are they getting the results that I want? If so, why don't I copy them in terms of that process? And that's really what I've tried to do here for you with regards to this document. So we're not going to read through this because it's self-explanatory. You can go read it yourself. So you've got each asset class. Equities, what is it? Why does it matter? Then you've got private equity and venture capital. What is it? Why does it matter? Crypto, what is it? Why does it matter? You've got, where to go now? Commercial property, bonds, primary and secondary homes, gold, passion, and other. And then it basically goes to revised strategic portfolio allocation. So for 2025 and beyond. Obviously, this isn't like going to be there forever, but you know what you're looking at. So I'm going to start. I'm just going to look at both sides of the fence. We're going to start with the 20s, and then we're going to go straight through to the 80s, just to show you the comparison between the two. So in your 80s, you're looking for aggressive growth. Your 20s. Sorry, your 20s. In your 20s, you're looking for aggressive growth and learning capital. So your equities, you've got a 35% allocation, private equity, 15%. Both of these tend to be high growth. Crypto, 5%, commercial property, funds, REITs, 10%, commercial property, direct, 5%, bonds 5, primary, secondary homes 10, gold 2, passion 13. Okay. This is the decade for maximum risk and asymmetric upside. So that basically means asymmetric means like where you can have low risk, high return, like it's not necessarily correlated. They're opposite to each other. High exposure to equities, innovation, VC, and even passion assets, arts, collectible, NFTs, etc., education skills. Property is less accessible, but can be entered via fractional ownership or REITs. Bonds kept to minimal. Fractional ownership is wealth migrate, just by the way. Okay, now let's bounce just to see right to the other side of the spectrum. In your 80s, it's about legacy planning and maximum stability. So equities, which is the kind of the growth, is only 8%. Private equity, 1%. Crypto, 0. Commercial property, direct REITs, 30%. Bonds, 30%. Primary, secondary home, 20%. Gold, 6%. And other 5%. At this stage, the focus shifts towards capital preservation, stable income, and estate planning. Equities and private markets are minimized to reduce volatility and illiquidity. A strong allocation to bonds and property ensures reliable yield, income, and low risk, while gold offers a hedge against systematic uncertainty. Homes are often held for legacy or lifestyle reasons, and personal passions still play a small role in the quality of life. Make sense? So if you look at it in a table, you can see here the key macro-informed principles. So commercial real estate remains vital for inflation protection and stable income across all ages, split between direct and REIT. Equities should decline with age, but remain part of the portfolio for counter-inflation and maintain long-term purchasing power. Private equity and VC exposure is justified in younger decades, but should be scaled down due to liquidity and risk. Gold gains relevance in later years as a hedge against monetary policy risk, and crypto remains speculative and should be capped at 1 to 3% unless highly informed or risk tolerant. And then you can see here, like again, 20s, 30s, 40s, 50s, 60s, 70s. You've got all the different asset classes and you can see the percentages. And if you like colors, you can go and see the colors. So you can see again, exactly the same thing. And as the main interest, you can see your passion projects here in your 20s and then sort of how it comes down to your 80s. Remember, this is a percentage of your total portfolio. So you can see your percentage allocation and then you got your age group. So for those of you who like colors and graphs, for those of you who like numbers, there's your left brain people. And for those of you who like me, like pictures, there's your right brain people. It's important, it's very important that you take this, that this is not financial advice. So it's taking into account all of the long-term trends and everything else. And again, repeating myself from this morning, but when I shared this with the family office, they came back and they said, look, they like it in principle. There's nothing that they would disagree with, but they prefer to sit down with people one-to-one and do it in a personal one-to-one thing. And I said, perfect. As you know, if people join the mastermind, then they've got the access to do it one-to-one and go through the process. And if they don't, or for whatever reason, they don't join the mastermind, well, then at least they've got a cheat sheet that they can work from. And like any cheat sheet, it's never 100% perfect, but at least it kind of gives you a framework upon which to work from. And I just think that it's so much more exciting than the other 8 challenges I've done, or again, I don't remember how many. We should actually work it out one day, where we just talk about that one from Knight Frank and we kind of use that wheel, whereas now we've actually got something of real substance for people to work from based on their age group and everything else. So yeah, let's go to questions. And if we don't have questions, what I'd like to do is break up into some breakout rooms, because I think it's really materially important that we talk through this. And I'm going to put this document in the VIP room. So I'll put it in the WhatsApp group right now so that you can actually have it in front of you. So let me do that for you right now in terms of the process. And yeah, any questions? Any comments? I'd love comments or questions around what we've learned today, what Anthony's taken us through, what I've just tried to share with you, what an impact this would make. I know, as you know, a conversation, Connie, you and I had just yesterday, I'm sure you would have loved to have had this, a couple of years ago in terms of truly understanding how portfolios work, what they do, in terms of the whole thing. Because again, the financial planning industry is like just like chuck you in a box. And with all due respect, it's how do I make money out of you, fees, etc. You'll notice that private equity, commercial property, all of those things, gold, none of those things your financial advisor tells you to do. None, zero. They tell you to do bonds and equities. Done. So yeah, thoughts, comments? Come on. It's Wednesday afternoon.
Okay,
Listen,
Scott.
Yes, Ellen. Ellen, just before you go, I just want to say one thing because I forgot to say it. I just want to give everyone a heads up. I found out last night that my son is he's captain of the under-13A rugby team, and he's only got 3 games left. And for some reason, the game was on Saturday, and it's been moved to 1:30 on Friday. But I have to travel. It's going to take me about an hour to an hour and 15 minutes to get there, because as it would so happen, it's the same day that it would be an away game. I don't want to miss the game. So between Alex and I, we're going to run the session on Friday. And he's going to be here. I'm going to be in the car, but I'm just giving you guys a heads up. Back to time management. I know that almost every single mastermind member, I talk through what's important. For me, what's very, very important is, so I don't want to make me emotional, but is to be there for my son. So I have a quandary because obviously this session, I will make sure that we finish strong, but I will be in the car, and I've already agreed with Alex that we'll be running it because I'm not missing my son's rugby game. So, yeah. Sorry, Alan, back to you.
Okay, hope it goes well. Good luck for him. He'll do well.
Yeah, no, completely.
Okay, just a bit of, I always comment, I listen, because I'm older. This, you people all start off with, we're not giving any financial advice in this, you know, that whole introduction. My view is it's actually nonsense. Through whoever, everybody starts off with it, you go to real success or whatever, even yourself. Well, through the course of a lecture, you are giving financial advice. Not that I object to it. I think obviously we need financial advice because if you're investing, you haven't got a clue about financial advice. So I just made a comment because I think out of that, that's why the investing market is so poor, so bad, and so messed up. Okay, I can move on from there. This is the first time that also, I'm trying to help people on the screen, that I've been taught how to invest. I've got a lot of investments with Migrate, all the way down the line. All they do is take their fee per month. Every month they take it, and you never hear from them from 1 year to another. So I've started to obviously shift because I've been to Calio. So I'm saying, trying to help for you to agree with me. If you don't have somebody is an investing house or whatever, like a Calio or a Scott to train me with investments, you'll get nowhere in life with investing. Because that's what's happened to me. My investments haven't grown properly. You don't know what to do because you're not a specialist in it. I mean, I was in the motor business. You're not a specialist on the engine in the motor car. You haven't got a clue. You must say certain people have, but who's got knowledge how a motor engine works in a motor car and what you need to do and what's got to be put in. So you give your money to somebody, you go, and no one comes back to you. I was in London for 5 days at an investment course there. Thoroughly enjoyed it. Learned about buying and selling shares on graphs and all that. Not once on those 5 days, a reputable firm, did they tell you, I'll use the word a Calio. Okay, so all they interested at the end of the day, you can do an Investec, you can go to anybody down here, all over the world. All they interested is in taking your money, putting it where they think it should go. Then it doesn't do well, they don't come back to you. And so without that chart from 20 to, which I like, please send me one copy of it just with all the, so it doesn't got all the other shit on it. With all that stuff for you, 20, 30, 40, 50. never ever seen that anywhere. Being 70, I would have liked it. None of my stuff concurs to that. None of it. So it's the next point that if you go to anybody to invest, all they'll do is take your money, go and buy stocks and shares with it, and then leave you and want until whatever. But none of it is properly planned. I've got a lot of questions because I'm not used to it. Why have I got so little in shares, but more in property at the age of 17? Because you know why? I haven't been brought up, been trained about how to invest. I've just done my own things. So I just thought I'd add that to the comment today. I don't know what you're thinking. So a Calio that we need, needs to be a top-class investment company. Know what they're doing so that they can guide you properly. But if you don't have it, and you, by the way, I keep on coming back to it with all the stuff that you give out. You should be the most wealthiest billion man with all the shit. I'm not joking. With all the stuff you do, it's incredible, Scott. I have to give you compliments. You don't hear it. You don't get it. I challenge anybody on your portal who you're doing their portfolios for them. If I'm talking nonsense or not, I need to be corrected.
No, look, well, firstly, Alan, thank you.
No, am I right or wrong?
I love that saying, from God's mouth to, what's it, from your mouth to God's ears, you know?
I just want to be told, am I right? Am I right or am I talking nonsense?
No, look, I mean, you know, you and I have had this conversation a couple of times. I feel, I mean, I think we're very, very, very closely aligned where, you know, back to, this started for me with my father going bankrupt and following all the advice that he was given, and it was the wrong advice. And, you know, I hear these stories every single day, unfortunately. And you know, my thing, you know, I was literally talking to someone last night or this morning about purpose. And one of the things I'm truly grateful for is I get to live my purpose. And I truly believe my purpose is to enlighten people, to educate them so that everybody can invest like the top 1%, and in some ways inspire them as well, in terms of what's possible. Now, what's happening with the likes of the family office, and because of the mastermind, me too getting access to the mastermind and the family office, is that it's changed my whole paradigm. You know, like I used to, if you'd asked me 15, 20 years ago, I'd be like, yeah, go buy houses. Like, that's what I did. Like, go read Rich Dad Poor Dad. Like, they say buy houses. I bought lots of them. And I helped thousands of other people buy houses. But then I realized, hang on, but that's not what the top 1% are doing. And then it was like, okay, well, maybe it's commercial property. And so we went and did commercial property, and it is commercial property. You can see they've got an allocation of over 30% in commercial property, depending on your age group. And, but then it was like, but there's all these other things, structured notes and asset allocation, and how do you do this, and the 6 pillars to wealth. So what, I mean, Alan, the way I'm trying to answer your question is that obviously I've evolved, the team's evolved with the knowledge and the understanding. And then the biggest thing for me with the family office is that being able to be let behind the curtain has been eye-opening. And it's only been it'll be 2.5 years pretty much that I've been working with them since 2012, but I've never been properly behind the curtain like I have in the last 2.5 years. And that's just been an eye-opener for me. And so what I've been trying to do, where I think I'm aligned with Garth on this, is to democratize. Garth spoke about democratizing and giving access. And Rose, I know you asked a question here, and my strong recommendation, because you were asking about the fees, etc. And my strong recommendation is, you know, book a discovery, not a discovery call, like just literally, Kelly, if you can just help Rose out and literally sit down one-to-one with Alex. He can take you through it. He can explain how it all works, and make sure that you're getting set up for success in terms of that process. Because I think back to what Alan's trying to say is that the typical way it works in the industry is just generally how many fees can that company earn. Their overall thing, all they care about is assets under management. So it's called AUM, assets under management. And the more assets they can get under management and the more fees they can charge, the more money they can make. And whether the market goes up or down, they don't give a shit. It's basically got to do with how many assets they've got under management. And what I like about, back to fees even, is the way that we've set up our fee model, the way that we work with the Calio team, is that it's all based on results and performance. And that's very important, you know, because, you know, we should be getting results and performance. And then lastly, what we've tried to enable results and performance is that, as much as I would like to say, hey, Scott, you went out and you built Wealth Migrate. I mean, we spent somewhere between 23 and $25 million building Wealth Migrate, just to put in perspective. And that's a lot of money to invest in technology and compliance and structuring and everything in between. And I thought it'd be as easy as, there's the platform. The whole world, there's the platform. It's $10. Anyone use it. And that's when the more we learned about the psychology. And actually, people don't believe in themselves and they don't trust themselves and they want the knowledge. And so that's why we built the Wealth University. And, over the years, we've learned that now there's extra levels to it, like coaching and doing what we're doing right now, which is facilitated Q&A and removing blockages and getting clear. And I think, Alan, I'm trying to answer your question that there's a lot more involved when you consider what a family office does than a typical financial planner, which is just take this investment, invest. And there's a lot more in terms of management, psychology, setting people up for success, planning, all of that stuff. And that's what we've tried to evolve and bring in at the mastermind, because in simple terms, we want to help people get results. And if someone can't afford to be part of the mastermind or they don't qualify, well then, let's just consider that on the airplane, that the airplane is going from London to New York and the mastermind is first class. Well, the Wealth Hackers is business class, so you don't get the personalized one-to-one attention, but you get the digital platform, the digital connection, so that we can at least oh, sorry, I got muted somehow as well. So no, but just to finish, Alan. So the Wealth Hackers is kind of business class, and then finally, we've given access. Wealth University is free. Wealth Migrate is free. Everyone can get on economy class if they want to and fly on the same airplane. So that's our logic.
But just to help people with AI and obviously ChatGPT and something, why don't you put out an ad or get something designed? You will know better what I'm trying to say. If you've got ChatGPT, go into the market and advertise what you're doing. Like you as an Alan Ross, I've had a couple of comments coming through. I'm in the same boat as you. The problem, what I've come across, obviously, no one is prepared to talk to you about investments. No one's got anywhere to go to talk to you about investments. You're on your own. These people take your money. I mean, from A to Z, there's no advising you. You haven't got a bloody clue if it's a good investment or a bad investment. And so people get ripped off, hungry, and you give people advice like I've got to many people lately and saying, what do you have? I say, oh, geez, how come you've only learned this now? So it's a great thing you're doing. Obviously, Kelly, I've had many meetings with Kelly. I met with Anthony yesterday on the phone. I have to learn about that because I'm challenged and I have a different mind still because being left on my own as an orphan. Now I've got somebody over my head querying this, doing this, why that. So it's also a big change. It's not a case you just go to Calio and say, oh, you can sit back. So it's a fascinating learning curve. And I just think people should
try
and do this. Investment market is a horrific robbery business. I mean, I don't know if you agree with me.
Well, I do, and that's why I want to change it. Do you mind, Alan? I want to try and answer Rose's questions here, and I completely agree with you. I think the industry is horrific, and I think it needs to change. And there's a story of the starfish, and I don't know if you've heard it before, but the only way to change a system is to change it one person at a time, and that's what we're trying to do. That's why we do the challenges, why we have the Wealth Hackers, why we got the platform, the university, the mastermind, because if we can change it one person at a time, that's out there telling other people, it'll gain momentum in terms of the overall process. That's our kind of philosophy. Rose asked a question here. Said someone asked a question on the group this morning. Are the 17 assets uncorrelated? In yesterday's session, you spoke and showed tables about the prices of houses and rents being overvalued and undervalued by specific percentages. Please talk to this point. I do not fully understand how the rent is overvalued and what that actually means. Okay, so there's two different questions there. So the first question, Rose, is that if you're asking about correlated and uncorrelated. So you've got to diversify across countries to start off with. So can we agree that if property in America goes up or down, chances are property in England like won't necessarily go up or down. Like they're not necessarily that closely correlated. Now, if interest rates go up in America, the chances are interest rates are going to go up in England, like we've just seen, and then the two property markets are impacted. Like so the world is becoming closer and closer being tied together. Like 50 years ago, if interest rates went up in America, no one gave a shit in England, like as an example, okay, like, and vice versa. But nowadays the markets are so tied together that when one country, puts up, interest rates, the other one generally, because like inflation seems to be a worldwide problem now than a country specific problem, etc. But they still are quite uncorrelated compared to the stock market. Like if we wake up tomorrow morning and the New York Times crashed, not the New York Stock Exchange crashed last night while we were sleeping, like our stock market will crash this morning. Like the moment it wakes up, it'll crash. Like it's like nanoseconds as to how the stock markets work together. So they're completely correlated in terms of that process. Now, if you go to the asset class, so that's just across countries. I'm trying to give you an example of property, okay? Commercial property. Now you go into different types of asset classes. So like industrial logistics did really well during COVID because no people could go to shops. So everyone bought everything online and they needed logistics centers to be able to deliver. Whereas medical office buildings actually took a hiding because people couldn't go to hospitals and therefore like all this stuff. So people went to hospital for ICU for COVID, but all the other stuff, like if you need an elbow operation or a knee operation, it's all known as elective surgery. And all the people that support around elective surgery, the radiologists and all of those type of people, physios and all of them, okay, none of them had work because the elective surgeries were switched off. And so actually medical buildings did really badly during COVID, just funny enough. So I'm just giving you two examples of commercial property that were completely different in America. So remember, I've now stopped going between countries. I'm now in one country with one asset class. So that's why you've got to diversify across asset classes as well. And then the other part is also partners. Like you'll find sometimes that some partners are doing extremely well and others are not doing so well. And so you got to diversify across partners as well, because you don't want all your eggs in one basket with one partner in terms of that side. Now, obviously, if you take the 17 asset classes, and I can bring them up for you quickly if you want me to. Let's bring them up because it'll probably be easier to see them on the screen. Give me 2 seconds. I had to restart PowerPoint there. I don't know why it crashed earlier. So if we go down to the boom, where's the 17 gone? Here we are. So if you look here, like gold is completely uncorrelated with property as an example. Structured notes is more correlated with the stock market, but it also tends to be different. ETFs obviously are the stock market, so that's but that's the best way to invest in the stock market and equities. Private equity tends to be the complete opposite. Just by the way, I'm sharing a little thing here, but there's another document I'm going to share at some point, not today, but so I've been building out these different white papers, and one of them I'm going to be sharing is this one, private equity and investing. So how do you manage private equity and investing in and it talks all about this correlation in terms of this whole process and what to actually do about it. That's not ready to be shared yet, but I will be sharing that at some point. Then you got private, then you got venture capital, which is kind of startup businesses, and then you've got crypto. So hopefully, Rose, you can see here that what we try and do is we diversify across countries, we diversify across currencies, we diversify across assets. So even within property, there's different types of assets. We diversify across partners and we diversify across time. And this just gives you an example in terms of all the different areas of that correlation. So yeah, hopefully that helps you. But it does give you a pretty balanced portfolio across the stock market, secondary market, and then the primary assets, all the different types of primary assets. Okay.
Scott, are you not able to give us a lecture sometime about crypto? I'm told crypto is going to be $1,000 an ounce or whatever, and crypto, lithium, and gold are on their way up. Kelly's never brought up crypto either. I think what I'm asking for, because you can't go to anybody else, so you know the story and my feeling. Are you not able to, during one of your talks here, put up some graphs for crypto, what it's done, what it's going to do? I mean, and then it becomes our choice to go to Kelly and say, well, please buy, like I can go buy $10 in that building in New York. Well, I want to take $10 and put it into crypto. I mean, obviously, I might put $1,000, whatever you can afford, ABC. I'm using the principle of it. Is it not possible over your courses you can do, I think, for crypto, put up some graphs for us, show us what it's done, what they expect it to do? Because it's something you need to be in that's going to be, I think, coming into force and it's going to take over whatever. That's how I understand it, reading generally. Are you able to do that?
So yes, I will. We did it in last year, but I'll redo it again. So that
I think it'll be wonderful to refresh us and say, geez, don't guys forget about crypto when you're doing all this. Please get some crypto into your portfolio, and what do you do crypto? Who do you do that? And who do you do it through? That's another thing. There's so many. I wouldn't know who to even go and if I wanted to buy crypto today, I wouldn't know who to go and even ask to buy the crypto.
Yeah. No, that's fine. So I'll do that. I'll take
Brilliant.
You through that. I want to. Rose asked two questions. I just want to make sure I'm answering her second question. So what I was trying to show you here, Rose, is that if you take the different countries, there's a number of different ways at looking at value, and so the one that people look at is kind of real prices. Okay, this is one that you generally see in the press. And real prices are where they take into account inflation. So let's just hypothetically say that the property market has grown by 10% in the year, but inflation is 5%. Well, then the real growth is 5%. Okay, so that's what that means. Nominal is where they don't take into account inflation. It's just the 10%. It's grown by 10%. Okay. Income is where it's based on affordability. So let's say, and it's been a while since I've lived in England, so I'm not up to speed with the current numbers. But when I was living in London, an average price, like a decent salary, like in kind of England, was somewhere between 20 and 30,000 pounds a year. Now, Connie, I know I'm showing my age, so maybe someone in England can help, kind of help me out here, because this was like 20 odd years ago. Okay, so I'm going to guesstimate that it must be probably around 50,000 pounds a year now. I don't know. I can easily go do the research, but let's say the average salary that someone can get is about 50,000 pounds. I know in London it's much higher, to be 80, probably between 80 and 120. Okay, Connie, if you've got any idea on numbers, shout and tell me. I'm actually not sure. It's been a while since I've been in England.
Yeah, it's 35 per year.
Okay, there
in
we
the
are.
UK.
So 35. So it's actually not too far off, because it was somewhere between 20 and 25 when I was doing this. So anyway, 35 a year in England. Now you put a husband and wife together, and they're going to get about 70. Okay, so now you're with me. So they're earning, their total salary is about 70. Now you could borrow up to about 3.5 times your combined earnings. Okay, so if you've got 70,000 pounds, then as your earnings, you can borrow kind of 3.5 times that. So if you do the maths, that's 245,000. So call it 250, just to keep it simple. Okay. So you would be able to borrow up to 250,000 pounds. Okay. Now, assuming you're going to put down a deposit of 10%, generally actually you need 20%, but anyway, I don't want to confuse things. So let's just hypothetically say that you're going to borrow some money from your mom and your dad, whatever, okay? You can literally afford a property for 300,000 pounds. That's it. That's all you can afford. You can't spend any more money. So if the average property price in England is already 300,000 pounds, the chances of property being able to go up in value are quite limited because there's not enough people that earn enough money to be able to buy a house. So it constrains property price growth. And to give you an example of this, the last time I checked, the average age of a first-time homeowner in England is 42. Okay, so it takes 20 years to get enough money to start earning enough money to put down a deposit to be able to buy a house or apartment, okay, to basically get on the property ladder. So that's what it means when it comes to affordability, which is this third one here, which is income. And the final one is rent. So what it's basically saying is that if you've got a house and you can rent this house for a certain amount of money, is the property price like are you buying it at a good price with a good return, yes or no? And again, it's saying is it overvalued or undervalued? And you can basically see here that under rent, you've basically got based on rentals and average long-term rental returns that you should be getting, it's saying that properties in America are kind of 15% overvalued, whereas properties in Greece, I don't know, let's just use England because a lot more people understand England. Where's it gone now? Where's the United Kingdom gone? Oh, Britain. You can see that Britain is 39% overvalued. Okay. And so that hopefully explains to you, Rose, what I think you were asking. And that's the breakdown between the four. Now, if you ask me which one I use in terms of my models, and sorry, I'll share my screen again. The one I use in terms of my models over here is I use, in terms of value of property, I use based on income. Sorry, not income, rent. Rent. Because what I think is important is that any property should always be valued based on how much income it can earn for you. And no matter where it is, whether it's residential or commercial, it should be on how much it can earn for you. And therefore, that whether it's above or below on a discount, I did it on the rent. So yeah, hope that helps. Okay. I can see there's lots of comments of people agreeing with you, Alan, in terms of the industry. Thomas also made an enlightening thing there. Brahm, Nirvana, lots of people agreeing with what you've said here. I suppose the question is, how do we change that? Rose was asking about mutual funds. Are they part of mutual funds? I think you were talking about unit trusts. Yeah, look, unit trusts are a very South African thing. Well, as I understand, a very South African thing. And if you go back to, where would I look here? Here. Yeah, it'd be interesting to see where unit trusts are. My understanding is that unit trusts were a South African thing that was put together effectively as a REIT, which is a real estate investment trust. I mean, if you take Liberty and Old Mutual, they were all built to effectively help people invest in property using this process. So, they would come under this. I know REITs came out more recently, real estate investment trusts, but they're basically property funds, etc. But yeah, unit trusts are very similar to that if they're property based, and if they're not property based, then they're mutual funds, as you've said. But yeah, I'm not an expert. I'll be honest with you, the typical financial industry products, unit trusts, mutual funds, those type of things, I don't really understand. I don't really pay any attention to, and I don't really put any energy or effort into them. They were a fantastic way for Danny Gordon to make a hell of a lot of money. I don't know where you live, Rose, as a matter of interest, but in South Africa, he's one of the wealthiest men, and he's built a very big business in England as well. But yeah, it was basically doing what Alan's saying. Is like, how can we empower everyone to invest with small amounts of money? The only difference is that the only people who made money in Liberty Life and Old Mutual were the people who were shareholders. Okay, sorry, and so comes a defamation character my way. That's off the record. Anyway, okay. Any other questions or comments today? I know it's been a lot of information. Any other questions, comments, thoughts? Would you like to do a breakaway room so that we break away for 10 minutes and we just get in the room? I know we're well over time, but I can do it if you want me to. And you can just go and chat it through. Thomas, you got your hand up? Yep.
Yeah, just a quick question. My American contacts are asking any developments for the American market, any options, how to go about it if they are interested in Wealth Migrate?
There's only two ways at the moment. One is join the mastermind. So if they qualify for the mastermind, Calio has an office in Florida, and they can help people at the sophisticated level. So that we've got about, I stand to be corrected, but it's about 3 people that are part of the mastermind that are from America. For everyone else, we have to wait. Calio are in the process of trying to get their licensing. They've got licensing at the high net worth level, but the licensing so that we can do this at scale. And I don't know how long that'll take. But that's the process. I want to partner with them. If you did or didn't hear, they became a shareholder in the company, in our company, a couple of weeks ago, which is really exciting. And we're waiting. We're going to leverage off their licensing. I'm not going to America and trying to. The quote I was given to do licensing, I've had anywhere between $500,000 to $1 million just to get licensing in America. I'm not interested. So we're going to leverage off Calio's license if we can.
Okay, cool. Thank you.
Yeah. So awesome. Okay, just quickly, if you can just type in the chat box or give me a thumbs up, thumbs down. Do you want to call it, go for lunch, go for a toilet break, go home, do whatever you do, or go back to the farm for Alistair, or do you want to basically have a quick room where you can chat about it? I know today's a long one. Wednesday is always the longest one. You're going to say cheers. Okay, well, if you want to bounce, go for it. I'm happy, and then yep, need to go. So everyone's saying go. Okay, I don't think anyone's staying. Okay, cool. I'm going to say cheers, everyone. Thanks for an awesome session. And I will see you all tomorrow for Partners and Risk, which is, one of the biggest things. All of us have lost money before. How do we learn from that and make sure we don't repeat it? Cool. See you tomorrow. Bye-bye.
Thanks, guys. Cheers.